Hey Longhorns, we're back for another virtual lunchtime lecture. I'm Chuck Harris, Executive Director of the Texas X's, and welcome. Before we begin, I want to say thank you to all of you who donated when you registered for this event. Your gift will support our scholarships program and help us keep alumni connected around the world. You can give anytime to your alumni association at texasx's.org/give. And now, on to today's lecture from one of UT's rock star professors. This one is extremely relevant right now. It's called The Great Disconnect, Ideas from the Economy and the Markets. Professor Sandy Leeds has just kicked off his 20th year as member of the Finance Department faculty at the University of Texas and has served as president of the MBA Investment Fund for 13 years. Prior to joining the faculty, Professor Leeds worked for a private money management firm. It was one of 4 portfolio managers responsible for over $1.5 billion in assets. He also has a lot of legal experience in the area of securities regulations, conducting the hearing against the principals in the Sterling Foster case, a $75 million fraud case. He got his JD from the University of Virginia School of Law, an MBA from UT Austin, and a BS in investment management from the University of Alabama. He is a member of the Texas State Bar and holds the Chartered Financial Analyst designation. Thank you, Professor, for joining us today. The class is all yours.
Perfect. Well, thank you so much. Thank you for the introduction. Good afternoon. Thank you all for being here. So I was asked to talk about the economy and the markets today, as if there's anything going on here, just a bit of a pandemic, an election going on, and a lot of unemployed people and a stock market that's still doing very well. So what we're going to talk about today is what I talk about in a class that I teach, money and capital markets here at UT. It's my favorite course to teach. It's just all about what's going on and helping the students to put all the theory that they've learned into practice. So that's what we do. Here are the themes that I think you should be listening for today that we're going to go through. We've had obviously a terrible shock to the economy with COVID. Fiscal and monetary response was tremendous, just in how quickly it happened and how strong it was. But the recovery is slowing. I would expect it to slow more as we seem to be starting a third wave of the virus. We're going to need more stimulus, and that's going to increase our debt, which has long-term ramifications. There's a tremendous disconnect between the real economy and markets. And some of these reasons for the disconnect are valid, and others may scare us. And so I'm going to try to take you through all of them. If you haven't done it already, I think it's in the Q&A section or that you can click on where my slides are. There's actually an outline that's 3 pages that will help you to follow along and see the big picture of what I'm talking about today. So that I would encourage you to have that. What we're going to do though is most of our time is going to be spent on the first 2 sections. I'm going to take you through just an update on what's going on in the economy, and then I'm going to take you through the markets and what's going on. At the very end, I'll mention a couple other things that I think we should all be watching. If we have time at the end, we'll do some Q&A. I've found, having done a lot of this stuff, that for the majority of people, with everyone in here, we're better off if I do sort of the presentation that I've prepared rather than make up answers to questions. So hopefully there'll be time for that. But with that, let's go ahead and get started. So with the economy, I'm going to talk about GDP. I'm going to talk about the labor market, inflation, the virus, and Fed policy. So we'll start with GDP. And you see the slide up here that, what we had in the second quarter was the largest single quarter drop that we've ever had. And you can see it was a 31.7% drop. That's a little bit misleading. The way we calculate GDP is we look at how the economy did relative to the last quarter, and then we annualize it. And basically, the second quarter was about a 9% lower than the first quarter. And that might sound weird to think, well, if 9% annualized should be 36%, but what you're thinking about is think about 0.91% annualized, and that's how you get to 31%. In other words, 9% loss each semester, or each quarter would mean that you're losing off a smaller base each quarter. But the bottom line is this was a big drop. We're not going to keep dropping 9%, but that's what happened. What we're going to see in Q3 is that there's going to be a really big recovery. I think, it's interesting from a perspective of the election coming up, because this is going to be announced October 29th, and this is going to be the biggest positive quarter, the most positive quarter we've ever had. And you can see that the Atlanta Fed thinks it's going to be about 35% growth, and you can see other economists think it's going to be somewhat lower than that. Either way, it's going to be the biggest ever, and you have to wonder if people will be impacted by that. The reality is, though, the economy will still be at a lower level than we were last year. And so even with that big move, the biggest reason for this increase we can see on the next slide is that we've had tremendous fiscal policy support. And so this is a really, this might surprise you, but this is truly a bizarre slide, what you're seeing here. The idea of having a recession and seeing personal income increase, right? It's above trend. We did so much as far as sending $1,200 to every taxpayer who made below a certain level. You had that $600 extra of compensation for unemployed people, which for people, the average person making below $60,000 before they lost their job, with that extra $600 payment per week, they were making more than they were when they were working. And of course, no one thinks, from an economics perspective, that's a good idea to do. But you're making a trade-off, and the trade-off was we have to get this done quickly rather than trying to make sure that we don't give too much to any one person. And it worked. It's people lost their job through no fault of their own, and it kept people with income. People saved a lot of that income. Our savings rate went way up. Part of it was people, I think, rightly knew that money wasn't going to continue forever. And of course, those $600 payments have stopped. And for a lot of people, they've fallen off their state unemployment insurance. They're now on a federal program for a little bit longer. But also you had savings for people who didn't lose their job. I can tell you just from a personal perspective, I know that, my family has spent a lot less money. We're just not going anywhere. We didn't take any trips during the summer. We really don't go out to eat. And so everyone is saving more. So, the big picture with GDP is that we saw this tremendous drop. We're going to see a big recovery when the numbers come out for the third quarter. The future, everyone wants to know the future. Tell me what's going to happen with the virus, and I'll tell you the future. And so that's a really hard thing. And of course, it also depends on how much more stimulus we get. Let's move on to the labor market. So the labor market, when we look at the labor market, we get this monthly jobs report. And the jobs report actually has two pieces. One is an establishment survey where we ask employers what's going on. And that's what you see here. That's when we talk about how many jobs were created or lost. The really interesting thing on this chart is if you look where this chart bottomed in March, was that in 2 months we lost as many jobs as we had gained in the expansion. It's crazy. We had lost 22 million jobs. Now we've gotten a lot of them back very quickly, but the big picture is that it's slowing. If you look at the next slide, you'll see that low-wage workers were hurt the most. 28% of them who were making less than $40,000 were laid off. And of course, when you're making lower salary, you're going to have less savings to live off of. And so, these were largely service workers. And so that was, that was a problem. The pace of recovery is slowing. What you can see on the next slide is that in the first 2 months, we after we were losing jobs, we regained a fair number of jobs. But look at the last 3 months. Add up those last 3 months, and they add up to less than half of the prior 2 months, right? So so that recovery in jobs is certainly slowing, and that's alarming to everyone. You go to the household survey, and that's where we get the unemployment rate. And so you can see the unemployment rate in slide 8, where the unemployment rate now is 7.9%. You can see it went as high as about 14.7%. But really what happened was it was over 20%, just not in the stated records. What happened was we were misclassifying a lot of people. At the time when we spiked high up to 14.7%, we had misclassified, I think, close to 5% of people as employed when they were really unemployed. It was, these were unusual times, and sort of taking these surveys were difficult. We still have a misclassification problem, but it's shrunk. But so you can see that the unemployment rate much higher than what we reached during the financial crisis, when we peaked at 10%, and now we're at 7.9. One of the things that's happened, though, is a lot of people have dropped out of the labor force and are no longer participating. And so you can see this participation rate. The participation rate reflects everyone 16 and older who either has a job or is actively looking for a job, meaning they've looked in the last month. And so what you see is a lot of people dropped out. And sort of the classic example would be, think of in March that you were a waiter or waitress in New York and you lost your job. Are you going to be looking for another job? There are no jobs out there for you. And so if you don't look, you don't count as unemployed. So this drop in the participation rate is something that keeps the unemployment rate much lower than it really is, because so many people don't count as unemployed. So if we want a better estimate of the unemployment rate, I took the participation rate back to 63.4%. That's where we were. Right now we're at 61.4. Right at 63.4 was where we were in January and February, so right before the virus. And if you change that to 63.4%, what happens is you've got an unemployment rate of 10.7%. Then you add the 0.4% of people who are still misclassified. And my best estimate of the unemployment rate right now is 11.1%. Now, realize this happens in every recession, that we understate the unemployment rate. But I think it's important to realize that 1 in 9 Americans, who wants to work, does not have a job. And I think people who are working in February want to work. I think that's a pretty fair assumption. So we're in a difficult situation. If you look at the weekly jobless claims on the next slide, you can see this is people who in the last week, so this is through this number was just announced yesterday, and so about 898,000 people filed for unemployment insurance. That's the number of people who filed for the week through last Saturday. So this is a very current indication of the labor market. These are shocking numbers. If you look all the way back to March, you can see those two little bars where we were at, somewhere in the, let's say, 215,000, somewhere between 210 and 225, per month. We're now at 900,000 basically. The last, several weeks we've been in the 835 to 900 range. Prior to the pandemic, only once had we ever gotten up to somewhere around, I think, 700 or 800,000. There was just 1 week, one time, a long time ago that had happened. Now we're doing that every week. This is the 30th week. If you count those bars up, 30 weeks of this. I mean, we've never seen anything like this, and it just tells you that this is ongoing. And of course, it makes sense because a lot of support is going away. A lot of people don't have income. A lot of companies are running out of money, and so that's a problem. Let's move on to inflation. Inflation continues to be very low. Typically, when I talk about inflation, I talk about the PCE price index, which is the index that the Fed uses in their 2% mandate. But the CPI just came out, and so I put that in. The CPI on average, not all the time, but on average, is about 0.3% higher than the PCE, meaning when we get to 2% with the CPI, we're still too low. We want to be about 2.3%. on average with the CPI. But what you see here is that we have very low inflation. A lot of people have talked about the fact that if you look at the most recent data, you see that we've ticked up because, of course, with no demand, prices went down. Everyone gets angry hearing that prices went down during the pandemic because everyone spent time in the grocery store and they see the price of meat and the price of milk and so many things went up. But overall, in the basket of goods and services, prices went down. Now they've come back some. People want to annualize the last 3 months and say, oh, we're at 5% inflation. That's really not the case. We're just having sort of a normal bounce back. The greatest source of inflation in the recent numbers, I think this is interesting, is used cars. Oops, I must have put a slide out of order. Flip to slide 14. Yeah, there we go. I got them out of order here. But this is used vehicle prices, and so what you're seeing is these are up like 14% since we started the pandemic. The stories that are going around about that are that you've got people moving out of cities and needing cars because of that. People not wanting to ride mass transit, and so they're buying cars. But there seems to be a lot of demand. If you go back to the prior slide that I misordered, slide 13, inflation expectations are increasing. Expectations are crucial. And this break-even inflation rates, this is our expectations that are priced into the market. It's calculated by looking at the difference between the yield on a 10-year Treasury bond and a 10-year TIPS, a Treasury inflation protected security. But bottom line is you can see the trend, inflation expectations increasing, still very low because this is based on CPI. So if you think about a 1.75, that's sort of like 1.45 in the PCE, which is what the Fed looks at. So still low, but headed in the right direction. Expectations matter so much because expectations are how we set prices and how we set wages, and wages are just a form of price. And so it's self-fulfilling. If we believe there's going to be inflation, we raise prices, we raise wages. If we don't, then we have low inflation. And the problem with low inflation is that if you have low inflation and then all of a sudden you have another economic shock, you're in deflation. Deflation is very hard to end. Just look at Japan. And so we fear that even more. Other problems with deflation are that, if prices are going down, why would I buy today if it's going to be cheaper tomorrow? And so we see a lot of problems. The Fed would find it very difficult to end deflation. They found it very difficult to end this low inflation. So that's what we see there. If you go to slide 15, some people are worried about inflation. They're worried about inflation because of monetary policy, that we're doing all this quantitative easing, and people say we're printing money, which is true. But that money, it's not currency, it's electronic money. Those reserves are not getting loaned out. And so if you had money being loaned out, then we might have an issue. But that's not an issue. People worried about this during the financial crisis. It didn't happen. And I would say the same thing here. Fiscal policy is another issue. That people worry about inflation from fiscal policy from a couple perspectives. One is all the debt, that ultimately you can have foreigners distrust the dollar loses value, and then we have import inflation. That's sort of a longer term issue, even though the dollar certainly has been losing value. The fiscal policy, the other issue is, if you take this to an extreme and the government just prints money to pay all of us and none of us are producing anything, then you have a lot of money chasing after very few goods, and then you have inflation. Certainly you can say, but we've done that some with the CARES Act, and we have not enough at this point. The recent trend, as I said, some people think about that. The price of gold has certainly gone up. Part of that is that the dollar has lost some value. Also, it's just a flight to safety in uncertain times. Supply chain issues, which are somewhat resolving ourselves, and the dollar that I mentioned. I'll tell you sort of my big picture view is that I think, it's hard to have inflation when you have weak demand. And so, certainly you can have supply interruptions, and if we have deglobalization, that will impact us. Certainly, this March of next year, when you start comparing prices to March of this past year, it's going to look like inflation is high, but that's going to be a temporary thing. So that's not my big issue. And the reality is we want higher inflation because we're worried that inflation expectations are going to become unanchored and we're going to have we're going to end up with very low inflation. So that's what we see there. Let's move on to the virus. The big news we've been hearing about has been Europe. If you look at these numbers, you see that the number of cases scaled, per million on a 7-day moving average. Europe has finally passed us again. It's been a long time that they've passed us. I mean, I'll be honest with you. I look at these charts, and all I keep thinking about is why. Why is it that we have suffered from this so much worse? You can take a look at the next slide, on slide 17. And again, what you see are the death rates. You see Europe, it's picking up. You see ours are higher. The death rates have gotten much lower. We've really improved. I think there's much more understanding of the virus. I think that also you're seeing a lot of younger people get the virus now, and they fortunately are able to withstand it. If you go to slide 18, you'll see that we're, what it looks like is we're starting another wave. It's hard to believe we're going to be any different than Europe. Europe's, weather is a little colder than ours on average, certainly compared to Texas, right now. And so, I think that's part of why you're starting to see that fall peak. We're starting to see it now. Some places, much worse than others. Wisconsin has so many terrible stories right now, but a lot of really high rates, and in the Dakotas and things like that. This is really terrifying, because if you look at the first wave, back when we were all watching New York, look at how much lower it was. When we started the second wave during the summer, we started from much higher levels than the first wave started, of course. And now we're starting at higher levels than the second wave started. And so, the expectations of the people who study this are that the numbers are going to be really high. The death rates, fortunately, will be lower. But, everyone talks about shutdowns and the fact that, well, we're not going to shut down again. I don't think most of us rely on the government to make decisions. I think we all rely on our best judgment, or what we think is best for our family. That's what we think about is, I'm not waiting to hear what the governor says or anything else. We make a decision as to what we think is best. And I think, you're seeing that. You're seeing that a lot of things have reopened, and they're still, operating at very low levels. I worry that we're letting down our guard. That if you look on this next slide, you're going to see that, if you look from the past, you'll see numbers coming up as far as people willing to re-engage in society. And of course, everyone wants people to re-engage, but at the same time, are we sort of having this feeling that, I can't take this anymore right at the wrong time? I think it's also fascinating to see this, to see the difference in these views politically. I think that it's just a fascinating thing to me to think. Now, most of these numbers, the vast majority of these things, both Republicans and Democrats, think I don't want to do it right now. But at the same time, you do see noticeable differences, and I think that's disturbing. I think it's just all part of the polarization that's impacting our economy. The next slide talks about the issue of, will you take a vaccine? And some of the vaccines that I'm reading about, it sounds miserable. It sounds like you sort of get flu-like symptoms and that kind of thing, or a lot of people do. Hopefully that will be minimal. But what you see is that a lot of people are not ready to take a vaccine. I will say, I asked my students, and they're all ready, right? Because I think they just want to get back to a normal life, and I get it. But a vaccine that no one takes is not a vaccine, and so I think that's a really big issue. We'll move on to Fed policy. The Fed responded to the crisis, very quickly and very intensely, as did Congress, much quicker than normal, and that's what stopped this from becoming a bigger disaster. You can see that the Fed took rates to zero. You can see on the next slide that they have pretty much said that they think rates are going to be at zero. On slide 22, are going to be at zero for quite some time. For several years before they move rates up. Fed Chair Powell has said they're not even thinking about raising rates. So it is very, very far off. They've also done a massive amount of quantitative easing, and quantitative easing just means that the Fed is buying bonds, and that's on slide 23. I'm sorry, y'all, I don't control the slides, but and so you can see the Fed's balance sheet. And the Fed's balance sheet was about $4 trillion, and now it's about $7 trillion. Just to give you perspective, before the financial crisis, the Fed's balance sheet was somewhere around $800 billion. And so now, it's going to be 10 times bigger than it was 10 years ago. So really, really significant. That's, when they buy these bonds, what's that do? It pushes the prices up, keeps interest rates down. They can keep the shortest rates down by keeping the Fed funds rate at zero, but they're trying to keep the 5-year rate down because that keeps car loans, the rate on car loans low. They keep the 10-year rate down. Mortgage rates are correlated with the 10-year. They move with it. They're higher than the 10-year Treasury yield, but they move with it. They've also engaged in a significant amount of lending facilities where they've basically loaned money to institutions. They've loaned money on slide 24. They've loaned money to money market funds, in effect, to institutions that buy treasury bonds. The big thing that the Fed has done is this. They have said, look, we will loan money, and because they've said that, the private market has been willing to loan money. And in effect, the Fed has not had to loan much at all. Just by sort of providing that backstop, they have brought trust to the market. You can see on the next slide that Fed policy has worked. This is just the financial stress index from the St. Louis Fed, and what you see is measures of volatility, measures of uncertainty peaked right around March 23rd, which was when the Fed announced all of these plans. If you look at the next slide, you'll see, just as an example, I put this in here, this is the spread on junk bonds, high yield bonds. And you can see, again, it peaked right around March 23rd when the Fed said, look, we will even buy ETFs that buy high yield bonds. And in certain cases, they would even buy high yield bonds, particularly fallen angels, that sort of thing. But what you see is that these spreads have come down significantly, which makes it much easier for risky companies to borrow. The Fed has also changed how they implement policy, and this was big news. They've been working on this for a couple of years. This is not because of the virus, but they certainly wanted to get this announced, and so they had several problems that they were facing. That the economy is growing at a much slower rate than it has for the last 50 years. The neutral rate is lower as a result. The neutral rate is the rate that the Fed could set the Fed funds rate at. That's neither accommodative, it doesn't help the economy, or it's not restrictive, it doesn't hurt the economy. It's neutral. And so the neutral rate is much lower, meaning the Fed can't take the Fed funds rate up much higher. And so, or it can't take it as high as it used to be. That matters because it used to be during a recession, the Fed would lower rates on average about 5%. Well, if the neutral rate is 2.5%, and that's where we are, maybe we're a little bit above neutral when we have a recession, you don't have enough room to lower rates to really impact the economy. They also knew that low unemployment, like we had 3.5% unemployment, back in early this year before the virus, that was more inclusive. The difference in unemployment rates between white Americans, Black Americans, Hispanic Americans was much smaller than normal, and that's a great thing. And so they realized we don't want to raise rates and stop that too quickly in the future. The Phillips curve that they've always relied on has flattened, and let's go back to slide 27. We'll eventually get there to 27. The Phillips curve is this idea that that what happens is when you have low unemployment, we will have high inflation, and as obviously we'll see that in a second. And we've just persistently undershot inflation and haven't reached our 2% goal. And so they said, look, we have to realize we're going to, in even a normal recession, get back to that effective lower bound, 0%. We want to have a more inclusive labor market, and that we have to stop trying to raise rates in anticipation that inflation will increase. We have to wait till we actually see it. We need to average inflation over time, not think of 2% as a ceiling. And so basically what they said, and this is important for us in the markets, they're going to raise rates when three things happen. We reach full employment, and we hit inflation of 2%, and we're on track to moderately exceed 2% for some time. That's leaving rates lower for much longer. On 28, you can see the lower neutral rate. And so that's the idea that now, the Fed just basically thinks that you can take the Fed funds rate eventually when the economy is doing well up to 2.5%. And on the next slide, you can see the Phillips curve. You can have flashbacks to your economics class in college, where, again, it's just sort of saying, look, when unemployment goes low, I have to pay more for workers. And then what's going to happen is I'm going to pass those prices on to others. But of course, what the Fed has faced is what's called a flatter Phillips curve, meaning we had really low unemployment, but it didn't result in inflation. And so that's the world they're living in. Let's move on to the markets. And so let's start with this. Why have the markets done so well? And so, lots of different theories. One is that people are counting on a quick recovery and a vaccine. And so, you can see that there are a lot of vaccines that are sort of moving closer. We're also always hearing about hiccups in some of them where they're stopping the testing. We heard that about Johnson & Johnson earlier this week. But, again, my concern here is that, a vaccine that we're not taking isn't a vaccine. People are talking a lot about, are we going to have a V-shaped recovery? And if you look at slide 31, you'll see sort of all the different letters that people are talking about, a V-shaped, a U-shaped, and, the Nike swoosh and, all this stuff. I think it's pretty clear we're not having a V-shaped recovery. The only place that's having a V-shaped recovery is China, which is, of course, ironic. What I think we're having, and I think a lot of people would agree with this, you can see on 32, and that's the K-shaped recovery. Meaning, we've gone down, we've sort of come back some, but you're going to see, and what we're seeing already is some people doing really well and some people doing really poorly. And, this just sort of furthers the polarization in our country that, sort of the people who are making money continue to make money, the people who are, who are working at the FANG stock companies, they're doing really well. The people who are relying on tourism or the service industry or less educated, they're suffering. And that's not good for anyone. But that's the K-shaped recovery, and I think unfortunately that's what we're seeing. Another reason that we see the market going up is that even though earnings have dropped significantly, last quarter, the second quarter earnings, they were down about 31% year over year. That's a big drop in earnings. But of course, that was better than what we were expecting. We were expecting like a 43% drop. But the big picture is people are looking ahead to future earnings, and they're thinking that they're going to be really good. People also trust monetary policy. They trust the Fed to support the market. You can see that on slide 34, where, if you look, I put the press release down at the bottom of this slide, and where March 23rd, the Fed announced everything that they were doing, and look, the market bottomed. You cannot fight the Fed, and I think that's just an important lesson. Something I always tell my students is you want to learn from these lessons so that you don't panic the next time something happens. You can take a look at slide 35, and this is the MOVE index. A lot of people have heard the VIX index. The VIX is the Volatility Index. that measures the volatility in the S&P 500, or it's the volatility that's implied by option prices on the S&P 500. But when people are scared, volatility that's priced into options increases. And you know what? The same thing happened with treasuries, and that's what you're seeing here. The interesting thing is that the Fed was able to remove this, right? The Fed, by coming in and purchasing treasuries, by loaning money through repurchase agreements to financial institutions so they could finance their treasury portfolio or inventory, all that removed some of the volatility. Now, you will see at the very end, I'm going to talk about this, at the very end of this slide, I think I made a day or two ago, but I guess this is actually from October 9th, so this is a ways ago. You're going to see another slide with the move, but you'll notice that it's sort of picked up a little at the end. We'll talk about why that is, I think, in just a short while. Fiscal policy, what you see here, the CARES Act, this is where we got the $1,200 per taxpayer if you weren't making above a certain level. It's where we got, the payroll protection plan to keep people on the payroll. It's where we got this $600 of extra compensation. This was, it's estimated like a $2.3 trillion stimulus package. This was huge, and this is what kept the economy going and certainly helped the market. The next thing, though, is that the stock market, the stock market is not the little restaurant that's going out of business. It's not the dry cleaner that no one's wearing clothes. We all have our Zoomiforms now, where we have a shirt and shorts, and the idea is, look, the market is being driven by Facebook, Amazon, Apple, Microsoft, Google. That's what's driving the market. Look at the performance since the end of 2016. And you see, these are the stocks that have dominated. The S&P without these stocks hasn't done much of anything. And so, the companies that we see on Main Street, that's mostly not what the S&P is or the stock market is. If you look at the next slide, this is an important slide. I thought about putting it in twice, putting it in later again. But what you see is the top 5 stocks now comprise about 25% of the S&P 500. So think about that. 5 stocks out of those 500. So 1% of the number of companies make up 25% of the index. And what you can see is this chart is showing you, the blue line is showing you how big a concentration the top 5 stocks have ever been. So in other words, we've never seen a concentration like this. And realize the top 5 stocks, like in 2000, were different than these 5 stocks. Microsoft was actually in both times. But the point is that this is why the market's doing so well. These companies are not being hurt by the pandemic. Many of them are being helped by the pandemic. And in addition, they just don't. This is not a reflection of the economy, but this is also a risk factor, right? That when we see everyone piling into the same number of stocks, you see people piling out of things like energy, and you can see that on the next slide, where now energy, with the price of oil down, you see price of energy related companies down. If all of the energy stocks in the S&P 500 went to zero today, and God forbid, but if they did, the S&P 500 would be down a little over 2%. That's crazy. It's amazing to see how the world changes. Another reason the markets are doing well is low interest rates. It's the idea that there is no alternative. I've got 3 kids. I want to put them through college, and how do you get there putting your money in a 10-year treasury that today is yielding 0.74%, right? That's not going to get there. I know you're saying, but UT pays you so much. But no, I've got to save and invest. And when my alternative is 0.7% or 0.74%, I pile my money into the stock market, and that's what we all do. And I shouldn't say pile my money, because that makes it sound like there's a lot of money. But I put my money in the stock market. Another thing that's helped the market is a little bit less fear. This is the VIX curve, the volatility index. And what you're seeing here is, I have this from September 23rd, when you can see that the VIX was at higher levels than it is today, or last night when I put the second one in. And so, what is that? That's just showing you a little bit less fear, a little bit lower risk premium, priced into the market. We're a little bit less scared, and that means we will pay more for stocks. The biggest reason for the drop in the VIX, and don't hear this as a political comment because it's not, is that the market is becoming more convinced that we will not have a November or an election that goes into December. That as the polls have become more and more favorable to former Vice President Biden, there's a feeling in the market that it's going to be there's going to be a clear winner in the election. I think the thing about that, the problem with that argument is that if you look at the numbers, and I didn't put them in here, but if you look at the numbers, the number of Biden voters who are voting by mail much greater than the number than the Trump voters, the Trump supporters. And so, you certainly could have many states that on November 3rd, President Trump has more votes, and then in the coming week, Vice President Biden has more, ends up with more. So, I think that's an issue. So those are some of the reasons why the market's doing so well. Let's look at some of the things that should scare you about the market. First is just the fact that this was the fastest recovery ever. Where we went into a bear market and came back to a prior peak, 126 days. That's crazy. You see some of the other fastest times, but on average, it takes about 1,500 trading days. And just to be clear, there are 252 trading days in a typical year, right? So you're looking at whatever that is, 6.5 years or something like that to get back. We did it in 126 days. We have some high valuations. Look at the PE ratio on slide 43 that you see, price to earnings very very high. Now, what people are pricing in is the idea that earnings are going to come back, right? That earnings are going to come back. The question is how quickly. I think you're going to see that continue to get pushed out, but we're paying a lot for existing earnings. You can look at the next slide, the value of sort of all U.S. stocks relative to the size of the economy, and this is something Buffett often talks about. And what you can see is that we're higher than we were in 2000. We don't ever like to compare anything to 2000. You can see the yield on a portfolio, the traditional 60-40 portfolio, is particularly low, which means that prices are very high, right? So if you think about a yield, where you have 60% of your money, let's say in the S&P 500, 40% in the treasury bonds. So your yield is a combination of the dividends you get, which is around 2%, and then the 10-year treasury bond, which, as I said, is about 0.7%. You're looking at a very low yield. And so, how are you ever going to get back to normal returns? If you look at this, the median yield was 4.11%. And that was over half of the median return, which was about 8%. Well, how do you get to 8% returns if you got a 1.37% yield? And the answer is you don't, especially in a lower growth environment. If you look at the next slide, the next worry about the market is we're seeing the IPO market, really booming, and that might seem like a good thing, but it also scares us that there's a rush to sort of sell our shares to the public while we can. If you look on slide 47, you'll see that there's a lot of underpricing going on. Underpricing means, like, let's say a company goes public at $20. So the people who are fortunate enough to get part of the IPO pay $20. But then if it closes that first day at 24, we say it was underpriced by $4. The market was certainly willing to pay $24. So it was underpriced by 20%. The idea is, when you see a lot of underpricing, what you're seeing is a lot of enthusiasm in the market. They try to price it fairly, and there's it's still underpriced. Now, it's not nearly as bad as the tech bubble, but this shows us that there's a lot of enthusiasm in the market. Next slide, you can see that with this underpricing, we leave a lot of money on the table. In other words, in my example, we could have sold the stock for 24 rather than 20. And so again, other than 1999, 2000, there's more underpricing and more money being left on the table than any other time. Next slide. Here, what you can see is another thing a lot of people are worried about, and that is the growth of SPACs. SPACs, special purpose acquisition companies, also known as blank check companies. The idea is I start a SPAC. Let's imagine I sell shares. You guys all buy them, and we now have $1 billion. My goal is to take this company and convince some private company. Maybe I'm going to buy a company, but more often than not, I'm going to try to find some private company that wants to go public quickly. And I try to get Airbnb to merge with my SPAC. And let's just say Airbnb is worth $19 billion. We put it with the SPAC. In effect, now we have a $20 billion company. The people who bought the SPAC are going to be a 5% owner of Airbnb, and the Airbnb owners are going to be 95% owners of the new company. The idea that people are investing their money in sort of something that they have no idea what it is, that's sort of a strange phenomenon. Now, a lot of times there are sort of safeguards where if you don't like the company they merge with or they acquire, you can actually get your money out in many of these deals. But it just sort of still tells you that there's a lot of speculation. And other people say, look, this is the closest that you and I will ever get to a investing in private equity. And I say you and I, assuming that you're not very, very wealthy. If you are very, very wealthy, call me. The next thing that we're worried about is just growth has been beating value for so long and by so much. It shows, this is when I almost put in those 5 stocks again, just to say, look, there's this intense, concentration in a few names, and is that a good thing? When is value ever going to come back? Next thing that we see is, the rise of individual investors, and we'll see a couple slides like this, but this is the Robinhood effect, that people talk about, that, we've gotten, no commissions, and a lot of people said, oh, this was the equivalent of sports gambling. I was looking for something to do. Let's move on to the next slide. You can see that there's a lot of trading in stocks priced below $5. The next slide, you can see a lot of that's in the Robinhood accounts. And so, again, this sort of speaks to speculation, which is never a good feeling about the market. You can see on the next few slides, you can see a few companies that, look at what Zoom's done, 654% in the last year. Obviously very successful company, but boy, that's a big gain. Take a look at the next one. Peloton. Not surprising that Peloton is doing well, other than the fact they're not profitable. If Peloton can't be profitable during a pandemic, I'm not sure when it's going to happen. You take a look at the next slide. You see Hertz. Basically what I wanted to just show you was, look at that spike up in the middle of the chart. People started trading this bankrupt stock, this company that's going to end up, likely going to zero, based on ideas that they had no idea of what was happening. They had sold some of their fleet. That money wasn't going to the shareholders. It was going to, special purpose entity. There are things like that. Hertz went to a bankruptcy judge and said, hey, can we sell more shares even though we know they're going to be worthless? And the bankruptcy judge said, yeah, I guess so. Why not? And if these people are dumb enough to do it, and the SEC basically said, yeah, we don't really like that idea, and that went away. But what they're going to do is sell shares to effectively these Robinhood investors, and then help to pay some of their debt. But it wasn't going to be enough to get them out of bankruptcy. Take a look at the next slide. Let's talk about the bond market. When you think about interest rates, if I think about the 10-year Treasury, I think about it as reflecting the current Fed funds rate, what the Fed funds rate will be over the next 10 years, as well as a term premium. And that term premium is that extra compensation I need for the risk of locking in my money for 10 years. That term premium tends to increase with the volatility in inflation. But of course, what we see is the term premium has shrunk as inflation has been very low for a long time. So you combine a low Fed funds rate and not much concern about inflation, and you've got a really low yield. You can look and see that yields are negative on the next slide. where, if you take the yield you're earning and you subtract out inflation, or you just look at the yield on the Treasury inflation protected security, either way, you see that you're locking in, when you lock in a 0.7% return, if we have, 2% inflation, you're locking in a negative 1.3% return. Maybe it won't be that bad if inflation isn't that high, but you're locking in a negative real return. If you take a look at the next slide, you should be aware just that we've been issuing a tremendous amount of corporate debt. Companies wanted to borrow money to make sure that they could make it through the pandemic. Some of them are starting to pay a little of that back now that some of them see that they're going to be okay. We also see a tremendous issuance of government debt. And of course, the reason we see that is because we're running a tremendous deficit. I don't have a problem with the fact that we're running a tremendous deficit because of the CARES Act. I think we need to be helping these people who are in need. My problem is the fact that prior to the pandemic, we were on schedule to have $1 trillion deficit. To have $1 trillion deficit when you're at 3.5% unemployment is immoral. It's immoral to do that to our next generation, because what it does is it burdens them. It means that they won't be able to have as much fiscal stimulus when they have problems in the future. If you look at the next slide, who's buying most of this debt? The Fed is buying most of this debt. And so you're not seeing a huge supply, and that's why interest rates, the huge supply is not hitting the market. That's why interest rates aren't going up. If you look at the next slide, what you see here is you're seeing that while the VIX is sort of steady, that's in blue, the move, that volatility that's priced into treasury yields is rising. That's interesting. The reason that may be happening is there's more of a consensus that Biden is going to be president, that possibly there's going to be this blue wave where Democrats also have the House and the Senate, and what you see is a massive spending bill and much more debt. We'll see. The next slide, I think, is a really important slide. If you look back in February, March, you see yields coming way down. That means bond prices going up. Bonds were a great hedge as stocks were going down. As stocks dropped a little late August and early September, you didn't see yields go down, meaning you didn't get that diversification benefit from bonds anymore. That's what everyone's wondering. Is there any more downside to interest rates, or can interest rates go lower and bond prices go higher, or do we not get diversification anymore? That's an interesting issue that we're worried about. If you look at the next slide, you see that interest rates, low mortgage rates have helped home sales. You see home sales for existing homes, back to pre-financial crisis levels. Next slide, you see newly built homes, again back to before the financial crisis. This is low mortgage rates. It's also people realizing that they're going to be working from home. They want their fortress. They're moving out of the cities possibly. Next slide, you also see low rates have helped car sales. And so that's a lot of what we've seen there. Let's take a quick look at slide 67. I think I've got about 2 minutes left, but you've got the dollar has been weakening. Why? First of all, you saw the dollar strengthen, that flight to safety back in March. That was when everyone thought the world's coming to an end. I invest in the dollar and use those dollars to buy treasuries. Well, then it seems like we didn't handle the pandemic nearly as well as other places, and people lost faith. So you saw that we had a weaker recovery than was expected. Europe a little stronger than expected, although now they're having problems, but the euro strengthened. We said we were going to keep interest rates lower for longer, so people don't want to invest here. That moves the dollar lower. There's, of course, fear of the trade war and protectionism, and our deficit is growing larger and larger. I'll end with two last issues that for you to think about. I encourage you all to take a look at, start reading about Taiwan. Look at what China has done with Hong Kong. After 1997 saying, 50 years of autonomy for Hong Kong. I'm not good at math, but I don't think 50 years have passed since 1997, either that or I'm even older than I look. But this is, the same time you've got China with their internment camps, and now they're flying warplanes over Taiwan, right? I mean, this is a really scary issue that we should probably be talking about for the entire hour. And I would just say to you, you do not have to be in military garb to be an authoritarian dictator. And you put a suit on Xi Jinping, and he's no different. He is no different than anyone else we worry about. But he's a real threat. Finally, we end with income inequality. Big issue. You can see from 1970 to now, the share of upper income taking a percentage of aggregate income has increased. You see on the next slide, you see the same thing with wealth. The Fed's concerned about that, but the Fed can't do much about that. We worry about that with polarization. We worry about that now. Just stats came out yesterday showing a big drop in enrollment at community colleges. That's going to further income inequality. These are all problems. I'll get to the last slide. I know we did a lot of slides. That's what I like to do. If you're bored with something, I move on to something else. I send out a weekly market update about what's going on in the world. You're welcome to sign up at sandyleeds.com, and you're welcome to email me at my email address. I finished, I think, hopefully just on time. Thank you again for showing up and participating in this. And with that, I will turn it back over to Patricia.
Thank you so much, Professor Leeds, for joining us and for talking to us about all of the current events in the financial world. To those who submitted a couple of questions, we ran out of time. Thank you for those very much. Professor Leeds did put his email address up there, so if you have a burning need and you want to ask that question, you could do it that way. And we would also like to thank everyone watching for participating in our October lunchtime lecture, as well as those that donated to TexasX's when registering. And of course, don't forget to register for our November lecture. Dr. Sam Woolley will be discussing the ways in which social media has affected this year's election and other political events. And of course, that's just in time for Election Day. So you can register now at texasexes.org/lunchtime lectures. Thank you again for joining us today. We look forward to seeing you at our next event. Bye, y'all.